Welcome to the deep dive. Today we're digging into the sources surrounding that October 10th market meltdown. It was the sharpest drop we'd seen since April, wasn't it?
That's right.
Our mission here is to really figure out what the specific spark was, and maybe more importantly, the underlying vulnerabilities that made the market so fragile.
Yeah, and I think the main takeaway right off the bat is this was a classic risk-off event, almost textbook. You had these simmering geopolitical fears just colliding head-on with a market that was, frankly, already looking a bit shaky.
Okay.
What really stood out, though, was the speed, the sheer velocity of money moving out of growth assets. It was quite something to watch.
So the immediate catalyst, the thing that really lit the fuse, was President Trump's threat. That massive increase in tariffs he posted on Truth Social.
That was the start, definitely, but you've got to see it in context. It wasn't out of the blue.
Right. It felt like a direct response to something.
Exactly. China had just made its move the day before. They expanded export controls on rare earth minerals. And, these aren't just any materials.
Critical stuff, right? For defense, for tech.
Absolutely critical. So China was flexing its muscles, aiming at a strategic pressure point for the U.S. And then Trump didn't just respond with tariffs.
He also canceled the Xi meeting.
Yes. That just pulled the rug out. Investors had been kind of banking on that meeting as a safety net, a diplomatic put, if you will. Take that away, add the tariff threat. Well, there's nowhere for the market to hide.
Okay, let's look at the damage then, the numbers. The NASDAQ really got hammered, didn't it? Down almost 3%.
Nearly 3%, yeah. 2.98% to be precise. And the S&P 500 fell 2.32%. It was broad-based selling, but tech definitely led the way down.
Was that just the tariff fear, or was it maybe that AI froth finally coming off?
I think it was both hitting at once. The panic was real, though. You just have to look at the VIX.
The PE index.
Right. It surged about 33%.
Yeah.
Pushed above 21 for the first time in, over 2 months?
Wow, 33% jump. That's significant. How does that compare to, say, the sell-off back in April?
It felt different. April was more about inflation, interest rate worries. This spike felt much more about geopolitical instability, about a potential trade war really heating up. And you saw that in the asset moves.
The classic risk-off pattern.
Textbook. Gold rallied, pushed further past that $4,000 mark. But look at oil. WTI crude dropped over 4%.
Okay, why the big drop in oil? Usually geopolitical tension pushes it up.
Not this time. This was fear of demand destruction. The market immediately started pricing in a scenario where escalating tariffs just choke off global trade, slow down manufacturing.
Leading to less economic activity, so less demand for energy.
Precisely. A global slowdown fear trumped the immediate supply disruption fear in this case.
So the trigger was geopolitical, but the market seemed primed for a fall. Why was it so vulnerable right then?
Yeah, that's the crucial part. There were these pre-existing conditions, sort of, two big ones. First, that AI excitement had pushed valuations, especially in tech, really high, maybe too high. It's very stretched. Remember, the Bank of England had actually warned about a sudden correction just 2 days before this happened.
Timing. And the second weakness, the politics here at home.
Definitely played a role. The U.S. government shutdown was dragging on into its 10th day, and that meant a data blackout.
No jobs report, things like that.
Exactly. Key economic data wasn't coming out. So investors were essentially flying blind, trying to navigate this geopolitical storm without their usual instruments. When you take away the data, fear and emotion take over much more easily.
And that lack of data plus the China situation created this really interesting split in the market, didn't it? You saw big tech like AMD down, 7%?
Yeah, big drops there.
But then U.S.-based rare earth companies like MP Materials, they surged 11 to 15%.
That's the key divergence. It tells you everything about the shift in focus. Investors just slammed the brakes on forward-looking AI dreams and immediately started pricing in the hard reality of supply chain disruptions. Geopolitics became the only game in town almost overnight.
So this wasn't just a bad day or even a bad week. You see this as signaling maybe a more permanent shift from tech optimism to geopolitical risk being front and center.
I think it has to. It forces a reassessment. The market is now constantly looking over its shoulder at trade tensions, at resource nationalism. That optimism premium, especially for globally exposed tech, got seriously repriced.
It does feel a bit like echoes of the past. You mentioned the 1930s, Smoot-Hawley tariffs. It's an unnerving comparison. So maybe the final thought for you listening is this. If we are entering a period where trade wars lead to a stagflationary shock.
Right, that toxic mix. Rising costs because of tariffs and protectionism, but also slowing growth because trade is seizing up.
Exactly. If that's the underlying problem, how much can central banks actually do? Their usual tools are designed for demand shocks, not this kind of supply-side, politically driven mess.
It's a tough question.